the chart patterns called candlestick pattern. Now, I don't know whether we can see can we see me on the screen? Because I want to.
Yeah, we can see
We
you.
can see you. You can see me on the screen. Okay. Can you see this book?
Yeah.
Yeah. This is the book that I recommend you purchase and have a copy, because this book, if you read this book, you are going to understand the basic language of candlestick patterns. Although I know a lot of us, I'm not say a lot of us, but some of us might not have the time to read it. So that's why I'm here. I would go into that and show us how it's done. Now, forget about the colors that you see on the screen, because normally when you are dealing with chart patterns, especially on centralized exchanges, Binance, Bybit that I dealt with yesterday, you are going to see them in color green, and color red. Now, the colors are insignificant. In fact, expert traders kind of put off their colors, because those colors, they have a way of working on the mind to make emotional decisions. The white candlestick here is for a candlestick that is for when the market is going up, is green, is bullish. That means the market is going up. And the black is for when the market starts going down. That's what this means. Now, if you look at these two candlesticks that we can see here, we can see what is called shadow, upper shadow, lower shadow, real body. Now, what does that mean? Let's put our focus on the white candlestick here. Now, the high, that is the highest point at which that the market went to at that time frame. Each of these candlesticks represents a time frame. Let's say, for example, we are using a 4-hour chart. Or let me just, I think I need to show us what I mean by that. So this is a 4-hour chart. So each candlestick here, remember I said the colors are insignificant because it's green and red here, but we are dealing with white and black there. Each candlestick here represents 4 hours. So for every red or green candlestick you see here, this represents 4 hours. We can change it to 1 day. So for every candlestick you can see here, it represents 1 day. If I can change it to, I think I can change it to a month, even 1 week. Every candlestick you see here represents a month. So let's go back here. Now that we know that, so each candlestick that you see here represents a certain time frame. Let's call it the 4 hour for the purpose of an example. Now, the high is the highest point. I'm focused on the white candlestick. For the purpose of my explanation, focus on that. The high is the highest point the market went to in this particular time frame. That's, for example, let's say Bitcoin in this candlestick during the 4-hour time frame, Bitcoin fluctuated between 104,000 and 107,000. The high will probably represent 107,000. Meaning that it went up to that price, but it could not stay because people sold and it came down and closed, let me say, at 105,000. Let's say, for example, the open you can see here. Let's say that particular 4-hour time frame opened at $104,000 in price. It opened at that price. It went up to 107,000. But let me say it closed at 106,000. Then even in the course of that time frame, the low, let's say it also at some point came down to, let me say, 103. So that's why the low is there. That lower shadow is being formed there. I want us to really get this. Let's really get this. I'll go over it again because it's very key that we understand this. The open is where the market started for that particular time frame. That's where it opened. That's why that place is labeled open. The high, it went up to that price, but it could not stay there. It was sold. The lower shadow means that the market came down to a certain price, but it could not stay there. People purchased it and pushed the price back up beyond the open to close. Close is where this candlestick closed for that particular time frame. The close is where it closed. Like I said, this candlestick is going to be green in your normal charts. I'm going to move over to the black body, which is usually red in most charts. The black body is a similar example, but it has its distinction. So please, let's listen carefully. Now, the black body, the open is where that candlestick started during this example of a 4-hour time frame. The open is where the 4-hour time frame started. and that's where it opened. Now, the high, it went up, but that price could not be sustained. So the sellers pushed it down, and it came all the way down to what you can see as lower shadow. So the sellers sold to the extent that it came down to that price, but some buyers came in a bit and pushed it back up a bit to where it now closed. So the close is where it ended for that particular time frame. Then what you can see there labeled as real body, that's basically the body of the candlestick. So with more, I want to say this, with more screen time, you'll be able to understand what this means. If it sounds a bit complex right now, don't worry about that. With more screen time, you'll be able to see that. So I'm going to go into a candlestick. A candlestick can have different kind of bodies, but it's all the same concepts. It's all the same concepts. I'll go back here. The high is where it reached at that particular time frame. The close or open, for example, in the white one, is where it closed at that particular time frame. Where it opened, the low is where it went to, but buyers came in and pushed it up. So a candlestick could look like it could look like anything, but just have an idea that it can have different kind of bodies. Usually these lines, these high, those little lines up and down on the candlesticks are usually known as wicks. Now I'm going to go into this. This is, okay, long upper shadow, long lower shadow. This is basically the market. In the long upper shadow, the market came up to that price at some point, but it could not be sustained. So the sellers pushed it down. In the long lower shadow, the market came down to some point, but it could not be sustained. Buyers came in and pushed up the price. I'm going to go into this now. Like I said, the candlestick patterns, they are a language. It's a language. It's speaking something to you. It's telling you something. When you look at the chart, this is a bit basic now, but it's speaking to you. Now, let's look at this bearish engulfing bar. What does that mean? We can see two candlesticks. Now, the chart pattern we can see here, we can see that there was an uptrend. The white candlesticks show that there was an uptrend. Now, the bearish engulfing bar reflected. And what does that mean? It shows that there was an exhaustion of buying pressure. That's why we can now see the big black candlestick. In your normal charts, it's usually colored red. So we can see that started showing us that, look, sellers have come in. The market has been trending up for a while, but sellers have come in and they seem to be reversing the price. And you can see that the market simply went down from there. So the next thing that we can see is the bullish engulfing bar. Like I said, let's not be too crazy about the names. Look at what happened. There's a smaller body. The smaller body means that sellers tried to sell, but they are losing momentum. And that became very clear by the second candlestick, which shows that buyers came in at the opening price and pushed it up. So that shows that there is buying pressure there. If we look at this chart here, we can see that the market was trending down for a while. When that candlestick appeared, the bullish engulfing bar, it showed us that, look, the market is most likely going to reverse. Now, I want to point this out. We don't solely use the understanding of candlesticks to trade. We don't use it in isolation. We use other technical factors, but for now, we're going to be sticking with learning the candlestick patterns. Then I'm going to go into doji candlestick. What does that mean? Remember that this doji candlestick, what it represents is that there is indecision in the market. It represents indecision. The lower price means that the market came down to a certain extent. Buyers bought it back up. The higher price, it went up to a certain extent. Sellers came in and pushed it down. The little or no body we can see in this candlestick shows that there was a draw between people buying and people selling. It is more like a draw. So if we look at this chart pattern, it shows that there was an uptrend and the uptrend lost momentum. Both sellers and buyers had an equilibrium at the top there. So it kind of showed that, okay, sellers, the people pumping the market, they are losing momentum. So the market might enter a downtrend. That's basically what that means. The dragonfly doji, bullish candlestick. What does this mean? This doesn't represent indecision. It most likely represents the fact that buyers are winning. People pumping the market are winning. The long tail represents that sellers try to push the price down, but the buyers came up and took the price up, and the buyers were not able to push the price further than the opening price, but at least they were able to defeat the sellers to an extent. So it stopped at that zone. That's what this means here. So basically, the opening and closing price looks similar, meaning the market basically opened and closed at the same price, but sellers try to push. Remember, each candlestick represents a particular time frame. So for the example we are using, we are talking about this as maybe a 4-hour time frame. So let's say this is an example of what happened in a 4-hour time frame. So now we can see on this chart here, it looks as though, there was a downtrend, and the sellers lost out in trying to push the market down further. Buyers came in. That seemed to have been what we call a supply zone. Buyers came in, a demand zone. Buyers came in and bought, and you can see that it's entered an uptrend from there. Now, the next thing is the Greystone Doji. Now, what does this mean? This is very similar to what the other pattern like I said, forget the names, just focus on understanding what it means. This black candlestick is usually red on your normal chart. What does it mean? Buyers try to come in to push the price up, thinking the market is going up. During the example of the 4-hour time frame, sellers came in, pushed the price down, and pushed it a little below the opening price. That led to this candlestick. Now we can see that there was an uptrend, and the buyers try to push it up. Look at the highlighted candlestick there. The buyers tried to push it up, but no, sellers came in and pushed it down. And that kind of gave a picture of, the market is trying to, most likely is going to reverse from here. So what position am I going to take? So you can see that from the chart here, the market went down from there. The morning star. This is a combination of 3 candlesticks, as you can see there. Now, what does it mean? The first candlestick shows that sellers came in to push the market down. In the second candlestick, the sellers were losing momentum. You can see that the second candlestick is not as big as the first. So meaning the sellers were losing momentum. Then the third candlestick reflects that, buyers came in and they swooped everything back up. Like I said, we are picturing each candlestick here as a 4-hour time frame. Now we can see exactly the application of that pattern here. The market had been in a downtrend. Sellers have been pushing the market down. By the second candlestick, you can see that, they are basically losing momentum. And the third candlestick reflects that, buyers are taking over. And we can see that the market basically has entered an uptrend from there. The next thing we are going to do, we are going to look at the evening star candlestick pattern. What does this mean? Buyers came in, they were pushing the market up. The second candlestick reflects, sellers have come in, but they don't have momentum yet. The third candlestick being bigger than the second candlestick reflects, it seems like sellers are taking over. The people selling are taking over. That's basically what that means. And we can see it, the application here, the market was trending up for a time, at a particular time frame, was trending up. In the highlighted portion, you can see that buyers seem to be in charge. Sellers came in the middle candlestick there. And by the third candlestick, we can see that, the sellers have basically taken over. We can see that the market entered a downtrend from there. I know that this is a bit much, but that's why I said that we should read this book. The hammer pin. What this means, this is usually a very strong signal in the market. If you are using other indicators, which I will show us later, and you see this in your chart, this is a very strong signal to buy. What this means is that the long wick, the long shadow we can see under, the long lower shadow we can see there, means that sellers try to come in to push the price so low, but the buying pressure was just so much, and we can almost be guaranteed that it's usually the market will enter an uptrend from here. That's exactly what we can see in the next candlestick. The market had been going down. It had a candlestick that the market pushed down so much, but buyers came in, pushed it up, and you can see it entered an uptrend from there. The same thing with the shooting pan. shooting star pattern. It's just an opposite from the hammer pin pattern. What does this mean? Buyers try to push the price up, but sellers came in and sold it down so much that it went down so much, and we can know that that's an indication of, oh, sellers have come in. Most likely the market is going to reverse from here. We can see here, market was going up a bit. Sellers came in, pushed the market down, and that ended that. The Harami pattern. The Harami pattern shows that, oh, market has been going down a lot. Market went down a lot during the course of that 4-hour time frame, or that we are using as an example. In the second candlestick, the sellers are losing momentum. It's not clear yet that the sellers are that the buyers are dominating the second candlestick, but it is clear that the sellers are losing momentum. That's the same thing with what we can see here. The buyers from the first mother bar, we can see that the buyers were in charge. But by the second one, we can see that the buyers are losing momentum. The sellers were taking over. So we can see that in this chart, we can see that first of all, market was in a downtrend. From the highlighted portion there, we can see that, oh, the sellers are losing momentum. So we can be here thinking, okay, the market might enter an upward trend from here. There is clear signs that the sellers are losing momentum. So that's just that. I don't really use this particular signal a lot, but it's good we have knowledge of this. The tweezer bottom. What this means is that sellers try to come in the first candle, push the market down, but buyers came in, pushed the market up, and basically this is usually an indication of a reversal. The same thing here with tweezer top. Tweezer top means that this occurs usually at the top of an uptrend. So I'll just go into, you can see there was a downtrend here, buyers came in, reversed that sell pressure in that last candlestick, and it was almost a clear indication of an uptrend. Now, we are coming to the end of the candlestick section. This, what you can see here, is an uptrend. Basically, this is a higher high. You can see HH means higher high. In an uptrend, the market makes higher highs and higher lows. Basically, the market doesn't go up in a straight line. It doesn't go up in a straight line. It goes up, comes down, goes up, comes down. So this is an uptrend. There are basically two kinds of market patterns. There is called trend following and mean reversion. This is an example of a trending market. The market makes higher highs and higher lows. You can see that the lower points kept getting higher and higher. That's what I mean by higher lows. Now, this is a downward trend. The market is trending down. In a downtrend, the market makes lower highs. Remember, the market doesn't go down in a straight line. It makes lower highs and lower lows. You can see with each lower low, it gets lower and lower and lower and lower. Now, this is, like I said, there are two kinds of patterns in the market. It's called the trending market, and there is the mean reversion. This is the mean reversion. What this means is that the market is simply revolving around a certain range. So usually you want to buy at the bottom of that range and sell or short at the top of the range. So that was a lot to cover, but I think we are done with the basic candlestick patterns.